Okay, I'm going to lecture on Module 3 and Module 4. However, this will not be included in the quiz tomorrow evening because I already announced that your quiz will cover only Module 2. However, this will be included in the long exam on Monday because your long exam on Monday will cover the topics in modules 1 to 4. However, the chapters will only be 1 and 2. So take note that this part 3, module 3 and module 4 will be included in the long exam on Tuesday gali. That will be on December 1. And may I remind you that the quiz tomorrow evening will be good only for 20 minutes 20 minutes, and I have already announced that it will begin from 5:30 to 5:50 and will cover only module 2. However, the long test on December 1, which will cover 5:30 to 7:30, that will be to include modules 1 to 4 and chapters 1 and 2 of the book. So I hope that you'll be guided accordingly. Okay, so let's now go to the module 3 topics. Now you may have these topics viewed in the canvas under the PDF, or you may also have this in your PowerPoint presentation. So we now go to the special accounting topics for business combination. Number 1 is goodwill to be computed, the different methods in determining goodwill. Though we have the general method already discussed, that we determine goodwill as the difference between the total consideration transferred and the market value of the net assets. So in that case, in the general formula, your total consideration transferred should exceed the market value of net assets for goodwill to exist. However, if you have the reverse, then there is no goodwill, but there is gain on bargain purchase. Okay, now we go to goodwill this time. Only goodwill that arises from a business combination is recognized as an asset. Goodwill arising from other sources or the internally generated goodwill is not recognized. The amount recognized as goodwill is determined on the acquisition date of a business combination. Subsequent expenditures on maintaining goodwill are expensed immediately. In other words, they will no longer be debited to goodwill. Subsequent to initial recognition, goodwill is not amortized, but rather tested for impairment at least annually. In other words, at the end of the year, you may determine the value of the goodwill, determine the value of the goodwill. And if there is any reduction, then you have your impairment loss. In other words, you have to test the value of goodwill at the end of the year, though you do not amortize it anymore. For this purpose, goodwill shall be allocated to each of the acquirer's cash-generating units in the year of business combination. If the allocation is not completed by the end of the year of business combination, it must be completed before the end of immediately following year. So meaning that's 1 year after the year of the business combination. Cash generating unit is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or groups of assets. Goodwill shall be allocated to the cash generating units expected to benefit from the synergies of the business combination. The methodology used to assign goodwill must be reasonable, supportable, and applied in a consistent manner. For example, goodwill may be allocated based on the relative fair values of the cash generating units. Now we begin with illustration number 1, the application of the direct valuation method. ABC is contemplating on acquiring XYZ Incorporated. The following information was gathered through a diligence audit. Okay, we have the actual earnings of XYZ Incorporated. The following information was gathered through a diligence audit. So we have years 1 up to 5, and we have the earnings for a total of 6,900,000. Earnings in 20X5 include an expropriation gain of 400,000. The fair value of XYZ's net assets as of the end of 20X5 is 10 million. The industry average rate of return is 12%. Probable duration of excess earnings is 5 years. So we have this data, and we are going to apply the different methods in determining goodwill. However, take note that we have those data to apply in our computations. Now, in method number 1, we have the multiples of average excess earnings. Now, under this method, goodwill is measured at the average excess earnings multiplied by the probable duration of excess earnings. And it stated that the fair value of XYZ's net assets as of the end of 20X5 is 10 million, and that the average rate of return of the industry, meaning the industry, like for example, if it is a restaurant, now you have a restaurant to compare. If you have a bank, then use a bank to compare. So you have your benchmark of the industry. So the average rate of return of the industry is 12%. Probable duration of excess earnings is 5 years. So probable duration of excess earnings is 5 years. So we now get this goodwill as the measurement is at the average excess earnings multiplied by the probable duration of excess earnings. Now, the total earnings for the last 5 years is computed at 6,900,000. And we have to deduct the expropriation gain, which is given at 400,000. Now, this is not an ordinary gain, but this is included in the total earnings. So we have to deduct the normal earnings for the last 5 years is 6,500,000, and we divide this by the period of 5 years, giving us the average annual earnings of 1,300,000. Now, the fair value of Aquarius net assets is given at 10 million, and we multiply this by the normal rate of return of 12%, giving us the normal earnings of 1.2 million. And we have the average annual earnings of 1.3 million. Here we have the excess earnings equal to 100,000. That's per year. And so if you multiply this by the probable duration of excess earnings, that's equal to 5 years. We have the goodwill applicable of 500,000. Okay, so we now use goodwill here as computed based on the multiples of average excess earnings. Okay, next, in method 2, we are going to determine goodwill by capitalizing average excess earnings. So, under this method, goodwill is measured at the average excess earnings divided by a predetermined capitalization rate. Assume a capitalization rate of 25%. Now, the average earnings is 6.9 million minus 400,000, the expropriation gain, and we divide that by a period of 5 years. So that gives us 1,300,000 per year. That's for an average of 5 years. Then the normal earnings in the industry as 12% as the normal earnings. So that gives us the excess earnings of 100,000, and we divide this by the capitalization rate of 25%. So that gives us the goodwill of 400,000. So what we did was to capitalize excess earnings. Unlike in method number 1, when the excess earnings, we multiplied it by the probable duration of excess earnings. This time, we are going to divide the excess earnings by the capitalization rate. Now, in method number 3, we have the capitalization of average earnings. Under this method, the average earnings are divided by a predetermined capitalization rate to estimate the purchase price of the business combination. The excess of the estimated purchase price over the fair value of the acquiree's net assets represents the goodwill. Assume a capitalization rate of 12.5%. Okay, so we have now the average earnings of 6.9 million minus 400,000. We now get the result of 6.5 million, and we divide this by a period of 5 years, giving us the average earnings of 1.3 million. 1.3 million, and then the capitalization rate we are using is 12.5%. We now get the estimated purchase price of 10,400,000, and we deduct the fair value of the net assets already given in the data. We have the goodwill of 400,000. Now, the difference between methods 3 and 2 is that in method number 2, we are capitalizing the average excess earnings. That's why the average excess earnings of 100,000 is the one that we capitalize. When we talk about capitalization, we are dividing an amount by the capitalization rate. So that's why in number 2, you got the amount of 400,000. What we capitalized was the average excess earnings. Here, we have the capitalization of the average earnings. So the average earnings that we have here is already computed as the goodwill. Our average earnings of 1.3 million, and then that's the amount that we capitalized. Meaning we divided 1.3 million by 12.5%. The capitalized rate, and then we have the estimated purchase price of 10,400,000, giving us the difference as the goodwill. Notice that if the excess earnings issues in the computations, the amount directly computed is goodwill. On the other hand, if the average excess earnings issues, the amount directly computed is the estimated purchase price. Now, take note of this very, very important things. Now, in method number 4, presented a value of average excess earnings, present value of average excess earnings. Under this method, goodwill is measured at the present value of average excess earnings, discounted at a predetermined discount rate over the probable duration of excess earnings. Assume a discount rate of 10%. Again, we have to use the average earnings as computed of 1.3 million. We have the normal earnings in the industry at 12%. Here, that's the normal earnings, no, in the industry. So we now get 1.2 million, giving us the excess earnings equal to 100,000. So the normal earnings in the industry as given in the problem is 12%. Okay. However, the discount rate to be used is 10%. Now we multiply the excess earnings of 100,000 by the present value of an ordinary annuity at 10%. Now here, we are already using the discount rate of 10%. So we have the period of 5 years. We have the present value factor, which you may compute in your calculator, though we have a book with a table where we can find this. We have the goodwill of 379,079. Okay, that's as far as our first learning objective is concerned. The learning objective, which is compute for goodwill in relation with business combination. Now, our second objective is define and illustrate reverse acquisition. And the third will be to define and illustrate combination of mutual entities in relation to business combination. So we now go to objective number 2. We have to illustrate reverse acquisition. In a business combination accomplished through exchange of equity interest. Now we were talking in module 2 about share for share. So exchange of equity interest. The acquirer is usually the entity that issues its equity interest. However, the opposite is true for reverse acquisition. So instead of the acquirer issuing the equity interest. In a reverse acquisition, the entity that issues securities, the legal acquirer, is identified as the acquiree for accounting purposes, while the entity whose equity interests are acquired, the legal acquiree, is the acquirer for accounting purposes. That's why we call it reverse acquisition, because the legal acquirer is now the acquiree and the legal acquiree is now the acquirer. For example, ABC Company, a private entity, wants to become a public entity but does not want to register its shares. To accomplish this, ABC will arrange for a public entity to acquire its equity interest in exchange for public entities' equity interest. In the example above, the public entity is the legal acquirer because it issued its equity interest, and the private entity is the legal acquiree because its equity interests were acquired. However, when applying the guidance provided under PFRS 3, the public entity is identified as the acquiree for accounting purposes, the accounting acquiree, and the private entity is identified as the acquirer for accounting purposes, the accounting acquirer. So in other words, we have the reverse treatment. Measuring the consideration transferred. In substance, the accounting acquirer usually issues no consideration to the acquiree. Instead, the accounting acquiree issues its equity shares to the owners of the accounting acquirer to enable the accounting acquirer to obtain control over the accounting acquiree. As such, the acquisition date fair value of the consideration transferred by the accounting acquirer shall be measured as an amount based on the number of equity interests the legal subsidiary or the accounting acquirer would have had to issue to give the owners of the legal parent, or the accounting acquirer would have had to issue to give the owners, the legal parent, the accounting acquiree, the same percentage of the equity interest in the combined entity that results from the reverse acquisition. Okay, so will you try to correct? There's a double line here. Uh, Based on the number of equity interest, the legal subsidiary or the accounting acquirer would have had to issue to give the owners of the legal parent or the accounting acquirer. So there's a one line to be deleted. Now, conventional acquisition versus reverse acquisition. We have the conventional and the reverse. The issuer of the shares as consideration transferred. The issuer of the shares is the accounting acquirer. In reverse, the issuer of the shares is the accounting acquiree. Reference to combining constituents: accounting acquirer or the legal parent, accounting acquiree as the legal subsidiary. In the case of reverse acquisition, the accounting acquirer is the legal subsidiary and the legal acquiree is the legal parent. Measurement of consideration transferred. Fair value of consideration transferred by the accounting acquirer. In the reverse, fair value of the notional number of equity instruments that the accounting acquirer or the legal subsidiary would have had to issue to the accounting acquirer, that the accounting acquirer legal subsidiary would have had to issue to the accounting acquiree or the legal parent to give the owners of the accounting acquiree or the legal parent the same percentage of ownership in the combined entity. Now we have an illustration of reverse acquisition for January 1, 20X1, XYZ Incorporated, an unlisted company, acquires ABC Company, a publicly listed entity, through an exchange of equity instruments. ABC Company issues 5 shares in exchange for each ordinary share of XYZ Incorporated. All of XYZ shareholders exchange their shares in ABC Company. Therefore, ABC Company issues 40,000 ordinary shares in exchange for all 8,000 ordinary shares of XYZ Incorporated. The fair value of each ordinary share of XYZ on January 1, 20X1 is 200. The quoted market price of ABC's ordinary shares at that date is 40. So take note this time that ABC issues 40,000 ordinary shares in exchange for 8,000 ordinary shares of XYZ Incorporated. Okay? So what will be the effect of this? Statements of financial position of the combining entities immediately before combination are shown below. So we have now ABC Company, the legal parent for accounting acquire or the accounting acquiree this time in the case of reverse acquisition. XYZ Incorporated is the legal subsidiary, now the accounting acquirer. Okay, so we have the identifiable assets of ABC 1.6 million, XYZ 2.4 million total assets. Then we have the liabilities 1.3 and 700,000. Then for the share capital of ABC 10,000 ordinary shares at 10. And for XYZ 8,000 ordinary shares at 100. And for retained earnings of the two companies, the fair values of ABC's identifiable assets and liabilities on January 1, 20X1 are the same as their carrying amounts. Okay, so we have now the requirement, compute for goodwill or gain on bargain purchase. Okay, so we have to again recall what we have learned about goodwill and gain on bargain purchase. XYZ Incorporated lets itself acquired in legal form for it to gain control over the legal acquirer in substance. Combination, no? For that purpose. So XYZ Incorporated lets itself acquired in legal form for it to gain control over the legal acquirer. So we say XYZ now, who is supposed to be the legal acquiree, no? Supposed to be. It's the legal acquiree, but now it's considered to be the legal, it's considered to be the acquirer for that purpose. Since we have this considered to be as reverse acquisition. So what will happen now to the equity interest of the legal acquirer and the legal acquiree for the purpose of using what we call reverse acquisition. Okay, so in that case, we can just say that legal form of the agreement, XYZ lets itself be acquired. Supposed to be. ABC Company, as stated, issues 40,000 ordinary shares to XYZ Incorporated in shareholders in exchange for all of XYZ Incorporated 8,000 outstanding shares. The substance of the agreement, XYZ here. XYZ gains control over the legal acquirer, but XYZ gains control, though initially XYZ is just the acquiree. So it gains control over the legal acquirer. After the combination, XYZ gains control because it now owns 80% of ABC. It now owns 80% of ABC. Why 80%? If you will find in the given data, the share capital of ABC is a total of 10,000 shares. And now ABC issued to XYZ a total of 40,000 shares. So that's 45. Here we have 40,000 shares. So the total number of shares of ABC is now 50,000 shares. So if you divide 40,000, the ownership of XYZ over 50,000, it's actually 80%. It's 80%. Dividing 40,000 by 40,000 by 50,000. Now this is how we illustrate reverse acquisition. When computing for goodwill in a reverse acquisition, the consideration transferred is computed based on the number of equity interests the legal subsidiary or the accounting acquirer would have had to issue to give the owners of the legal parent or the accounting acquiree the same percentage of equity interest in the combined equity entity that results from the reverse acquisition. I will repeat this statements. When computing for goodwill on a reverse acquisition, the consideration transferred is computed based on the number of equity interests the legal subsidiary or now the accounting acquirer, that's XYZ, would have had to issue to give the owners of the legal parent, now the accounting acquiree, that's ABC, the same percentage of equity interest in the combined entity that results from the reverse acquisition. So we have now the accounting acquirer, XYZ, issue shares in the reverse acquisition. XYZ's currently issued shares is 8,000. 8,000. Shares to be issued to ABC shareholders to enable them to have the same interest in XYZ. So 8,000 shares divided by 80%. So that will give 10,000 shares. We multiply by 20%. So that will be 2,000 shares. So for the total 2,000 shares divided by 10,000, that will give a 20% interest. I will repeat, the accounting acquirer or XYZ issue shares in the reverse method. XYZ's currently issued shares given is 8,000 shares, and shares to be issued to ABC's shareholders to enable them to have the same interest in XYZ Incorporated is taken by dividing 8,000 shares by 80%. So that will be 10,000 shares times 20%. So that will be 2,000 shares. And 2,000 over 10,000 is 20%. So XYZ's currently issued shares is equivalent to 80%. If the business combination had taken the form of XYZ, the issuing additional ordinary shares to ABC shareholders, XYZ would have had to issue 2,000 shares for the ratio of ownership interest in the combined entity to be the same. XYZ shareholders would then own 8,000 of the 10,000 issued shares of XYZ, 80% of the combined entity, while ABC shareholders will own 2,000 of the 10,000 shares issued shares of XYZ that will now be given a 20% interest of the combined entity. The consideration transferred is computed as follows. Shares of XYZ effectively transferred to ABC 2,000. Multiply by the fair value per share of XYZ shares. Multiply by the fair value per share of XYZ shares of 200. So the fair value of consideration effectively transferred is 400,000. The fair value of the consideration effectively transferred is 400,000. And so we have now the goodwill or the gain on bargain purchase is computed as follows. The consideration transferred is 400,000. The consideration transferred is 400,000. Then we are going to deduct the fair value of net identifiable assets acquired. We are going to deduct the fair value of net identifiable assets acquired. So that is the difference between 1.6 million and 1.3 million. So for a difference of 300,000. So the goodwill is 100,000. Okay? So that is an illustration on reverse acquisition. Okay, now let's again recall our objectives for this module. Number 1, compute goodwill by using various methods. Number 2, define and illustrate reverse acquisition. And the third is illustrate combination of mutual entities in relation to business combination. So combination of mutual entities. Okay, so we have now The third objective in module number 3 is focused on combination of mutual entities. PFRS 3 defines a mutual entity as an entity other than an investor-owned entity that provides dividends, lower costs, or other economic benefits directly to its owners, members, or participants. Examples: a mutual insurance company, a credit union, and a cooperative entity. Mutual entities may be differentiated from other types of businesses on the basis that members of the mutual entities are both customers and owners. Members generally expect to receive benefits from their membership, normally in the form of reduced fees charged for goods and services or patronage dividends. The portion of patronage dividends allocated to each member is often based on the amount of business the members did with the mutual entity during the year. When two mutual entities combine, the acquirer gives member or equity interest in itself in exchange for the member interest in that acquiree. Consideration is transferred, but its fair value is not readily determinable by reference to a market. In such case, the acquirer determines the amount of goodwill by using the acquisition date fair value of the acquiree's equity interest instead of the acquisition date fair value of the acquirer's equity interest transferred as consideration. Now, let's have an illustration of mutual entities. ABC Cooperative and XYZ Cooperative are cooperative institutions. On January 1, 20X1, the two entities combined with ABC identified as the acquirer. ABC shall issue member interest to XYZ. As a result, members of XYZ become members of ABC. An estimated cash flow model indicates an acquisition date fair value of XYZ as an entity at 1 million pesos. The fair value of XYZ's identifiable net assets is 800,000. Required, compute for goodwill and provide the acquisition date journal entry. So we now have the consideration transferred equal to 1 million, and then we are going to deduct the fair value of net identifiable assets of 800,000, the amount of goodwill of 200,000. And then for the journal entry, we have to debit identifiable assets acquired for 800,000. Then we debit to goodwill for 200,000 and credit member interest issued. So we have now for the journal entry in the case of our mutual entities combined. Okay, I'll proceed to module number 4. Module number 4. This is, but anyway, I have told you that in our long exam on Monday, it will cover modules 1 to 4, but the chapters will only be 1 and 2. So even if I will be dealing with some topics here, just focus on the module. Don't mind the next chapter, only 1 and 2, no? No chapter 3 or 4. Okay, so our next topic is already part of module number 4, and we have now the learning objectives. 1, identify the elements of control in connection with parent-subsidiary relationship. 2, prepare consolidated working papers and statement of financial position at the date of acquisition. Okay, so we have now the nature of consolidated statements. IFRS 10 requires that an entity that is a parent must present consolidated financial statements that include all subsidiaries of the parent. Only 3 exceptions to this rule are available, and these are: a parent need not present consolidated financial statements if all the following criteria are met. So, no need of consolidated statements. A, the parent itself is a wholly owned subsidiary, or it is a partially owned subsidiary of another entity, and all of its owners, including those not normally entitled to vote, have been informed about and do not object to the parent not presenting consolidated statements. To B, its debt and equity instruments are not traded in the public market. C, it did not file, nor is it in the process of filing, its financial statements with Securities and Exchange Commission. And D, its ultimate or intermediate parent produces consolidated financial statements that are available for public use and comply with IFRS. So with all of this met, it's not only one of these, but all of the following criteria are met. So the parent need not present consolidated financial statements. Number 2, post-employment benefit plans or other long-term employee benefit plans to which IAS 10 employee benefits apply are excluded from the scope of IFRS 10. Okay? 3, an investment entity need not present consolidated financial statements if it's required to measure those subsidiaries at fair value through profit or loss in accordance with IFRS 9, financial instruments, or IAS 39, recognition of and measurement until IFRS 9 comes into effect. Now, the conditions for consolidated statements. Generally, statements are to be consolidated when a parent company owns over 50% of the voting common stock for another company, thereby having a controlling interest. However, control may be achieved even with less than 51% of the voting common stock is owned by the parent. In such case, the consolidated statements may be prepared in view of the unified managerial control. Now, actually, we have studied in module number 1 about business combinations that the two elements must be present in order for a business combination to be implemented. And one of this is control. And we have discussed that control applies if the ownership interest is 51% or more. However, there are exceptions to this 51% or more basis that we have already mentioned. We have three that even if the 51% or more requirement is not met, but if those three, any of those three conditions are met, then control may still exist or may still apply. Okay? Now, control. IFRS 10 introduces a new single control model to identify a parent-subsidiary relationship by specifying that an investor controls an investee when the investor is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. In this new control model, an investor controls an investee if and only if the investor has all of the following three elements. Okay? So we have now the new control model. A, power over the investee. B, exposure or rights to variable returns from its involvement with the investee. So we have returns. And C, the ability to use his power over the investee to effect the amount of the investor's returns. So we have now the link between power and returns. Okay, so we now go to our illustrative problem now for parent and subsidiary relationship. Actually, you can already find this in the next chapters of DIAG, but for the meantime, you just stick to the module. So we have now P company as the parent, S company as the subsidiary, and now we have the elimination entries and the consolidated balances. Now the main reason why we have to prepare elimination entries because upon combination, the parent and the subsidiary mean we consider only one company. And so all the reciprocal accounts should be eliminated. And that the shareholders' equity accounts of the subsidiary should likewise be eliminated. It's understood that the shareholders' equity accounts that will remain are only those accounts of the investor. Okay, so we now have our balances of both companies for the assets, the liabilities, and the equity. So for the assets, liabilities, and equity, as well of as company. Then for the elimination entries, so the first entry now is to debit. Number one, debit common stock of S company for 50,000. Debit APIC of S company 30,000. And debit retained earnings of S company for 20,000. So the total is 100,000 equal to the investment in S company. So investment in S company for 100,000, meaning we have now the elimination of the shareholders' equity account balances of the subsidiary, which equals the investment in S company. Now this time, take note that investment is at cost. What we mean by cost is that the amount paid for by the parent is just equal to the book value of the interests of the subsidiary. So after the elimination entries, we now extend the balances to the consolidated column. So we just extend adding the assets and the liabilities of the parent and the subsidiary. For example, P, cash, 130,000 is zero. So you now get 130,000. Accounts receivable, you also add the two amounts. And take note, the investment in S company being a debit, now you are crediting 100,000. The balance is zero. For the liabilities, we do the same. And for the common stock, only the common stock balances of P company, common stock, P company, APIC of P company, and retained earnings of P company. We already eliminated the shareholders' equity account balances. S company, 50,000 credit and 50,000 debit so that the balance is zero. Okay, so we now get the totals for here, the assets, and we have the liabilities to equal in the consolidated statements. Assets, 610,000 and liabilities, 390,000. The equity is 220,000. The sum of common stock, APIC, and retained earnings. Now take note that these shareholders' equity account balances are only those of the parent and no longer with the subsidiary balances. Now we go to illustration 2. For illustration 2 now, we have the same balances for illustration 2. For illustration 2, again, we have the parent and the subsidiary, and we prepare the elimination entries as well. Okay, so we now go to the balances for illustration 2. Take note that we are using the same amounts for the assets, the liabilities, and okay, so we have the statements, okay, in the okay, illustration 1, 2, okay. Okay, please wait for a while. We are trying to adjust. We are now in illustration 2. Okay. So, I'll wait for mga 10 minutes, ha? And then I'll have the continuation. Stop lang Zoom. Stop lang. Pwede mo na, no? Supunan mo lang. Supunan. Yan, no? Tapos mo lang na mag-supun, makontinue lang, no? Mga white to